Palantir beat expectations on earnings today and revealed some huge growth numbers like a 94% increase on deals, but still dropped 8% in after hours. But do remember, it was actually after coming up 8% during market hours leading up to the earnings. So it's kind of a wash, but we'll see what happens officially tomorrow. Now, there's a lot I personally liked about these earnings results and the call. So starting with the headline, Palantir came out right out the bat, highlighting their top line growth of 21%, which smashed last quarter's guidance as well as their 6 quarters of GAAP profitability in a row. So that's really the numbers they wanted to tout, and I'm gladly going to take this. They also highlighted a bunch of other metrics centered around their commercial business mostly, so let's just dive in. So starting with their AIP bootcamp organizations, this is one of the slides, we get a new number at more than 915 organizations in the United States and globally have completed bootcamps. Note though, this is the count starting from mid-2023, so it's like all of them, where in the last quarter's presentation, they highlighted more than 465. So it sounds like Palantir is on the path to smash out that number of bootcamps over last year's quite easily for the number of organizations. And when we go over the earnings call, we get a huge reveal on some deals they've gotten out of these bootcamps. Now, starting with GAAP net income for the numbers, Palantir continues to expand this metric 6 times positive in a row, although it's not growing as fast as some are hoping. I'm okay with this, even then with even minimizing it or not necessarily focusing on their GAAP profitability. If it slowly goes up, then I'll be happy with this. Plus, this means they're still keeping their S&P eligibility just to be entered into the index when it happens, which is the only thing that matters for this metric to me. Next, the profitability metric I care about more is the GAAP operating income, which grew about $15 million, showing their margin of safety to run their business is still there. I won't question this unless we see a decrease in the metric later on, but staying positive is still important, showing that management is being prudent about certain expenses like sales and marketing, research and development, as well as any administrative costs. But note, if we see AIP bootcamp scaling more, it'll be interesting to see if this will be affected. Then we've got a new metric that management wants to highlight, Rule of 40. It's a sustainability metric that shows if they're able to continue investing in themselves, all while still achieving a margin that has them in no danger of losing money, mostly for their technological moat as well as intellectual property. So it's a combination of two percentages with the footnote in tiny print that says the Rule of 40 refers to the sum of our revenue growth rate year over year and our adjusted operating margin for each of the periods presented, where 40 is the industry standard you want to exceed if you want to stay sustainable, and clearly Palantir has been expanding this and trended upwards the last 3 quarters. Now, we've got commercial revenue growth here. We get a whopping 40% growth for US, but do fall down to 27% when you group them all together. This was highlighted throughout the earnings call about the United States still being the bread and butter of Palantir's business growth-wise. Internationally, this still needs to take off considering you can see the 27% overall when it's all together. Then good news on the government side, we actually get 16% revenue growth with 12% US government growth, which also was highlighted in the earnings call where Karp is excited about the returning growth to this area. Last quarter, this was a bit disappointing, so it's nice that this metric is making a comeback. So these all added up to completely exceeding management's guidance from last quarter, projecting only around $612 to $616 million, which, projected only a 16.5% year-over-year growth rate for the quarter, but they pulled off the over 20% goal, for me at least, at 21%. And during the earnings call, we learned a lot of this was pushed by actually existing customers due to the sheer value of AIP, which expands customer usage and you'll see later on helps the net dollar retention. And then we have the breakdown of the adjusted operating income, and that's at 36%, which was used to help calculate the Rule of 40 here, helping it out a bunch actually. Essentially, they're scaling AIP, but still are healthily keeping their spending down. Now, the meat and potatoes I'd say that everyone was looking out for, US commercial count. We added 41 customers this quarter, which was just one more than the 40 we gained last. Now, the sequential percentage of 22 to 19 is just a product of increasing baseline, but this continued addition at these levels are much more encouraging than we see in those previous quarters. So even if sustained, it seems like the bootcamps are able to win over customers, although I'd like to see this scale up even more. But with this, we also get the total customer count finally exceeding 500 at 554, where the commercial customer count is a whopping 427 now. So that's inclusive of both international and US. So out of the 52 added, 41 were US and 11 international. Hopefully we can see some adoption globally in later quarters commercially. Now, for the $1 million plus deals, all of these buckets decreased actually from the previous Q4 slide we had before. Now, Q1 traditionally is a slower deal closing quarter, not only for Palantir, but just in general. So I think it's still important to note these are $1 million plus deals. So the number provided by management during the earnings call makes them excited, albeit it's less than this threshold. Now, for Palantir's cash hoard, it has continued to grow, being $3.9 billion now. We are almost at the $4 billion mark here with their positive adjusted cash flow from operations. It's down from the last year, though, but still positive and allowing them to grow this healthily. And we know a lot of this is still sitting in treasuries from their balance sheet around $3.3 billion. Although their cash position did go down around $300 million, it's because the cash was reallocated towards these treasuries, having increased around $500 million. Then the net dollar retention has increased again to 111%, up from 108%. Honestly, this is nice to see finally some pickup in this metric. It gets highlighted by management during the earnings call, which was a big contributor to the revenue expansion this quarter because they were able to get more dollars from existing customers. Plus, since this is a delayed metric looking at existing customers, with all the new deals that they're signing, we can further see in later quarters how well they're actually keeping these customers, the new ones at least, to spend more. Then the best surprise to me was guidance. We get upward revisions to the top line guidance for Q2 2024, as well as the full year. We get an increase from $2.652 billion to $2.668 billion to now $2.677 billion to $2.689 billion, meaning the new bottom end of full year 2024 guidance is higher than the top end that they provided previously. Then for Q2 2024, they're projecting $649 to $653 million in revenue. Now, with quick calculations from the last year of Q2 2023 revenue, this guidance, if they hit the top end, is a growth rate of 22.5%. So not only are we continuing the upward trajectory of the 21% quarter, we're now guiding even higher for the next quarter's growth rate. So I'm honestly pleasantly surprised from this. Now, the earnings call, we get a lot of similar talking points that reflected the financials, but the overlaying narrative they spoke about was the United States commercial and the success of boot camps. For instance, they said there was a 7-figure deal signed 7 days after boot camp, as well as another 7-figure deal signed within a few weeks. So these are bringing in real customers willing to pay once they get the value. Now, the big highlight that wasn't in the presentation slides was their US deal closure, and that went from 70 from last year to 136, and that represented a 94% growth rate for that metric. This includes the deals under $1 million, hence why this big gap isn't contributing the $1 million plus deal slide. Now, the main thing that I cared most about came from Dan Ives' question, actually, and it was the conversion rate for AIP bootcamps. Unfortunately, we don't get a clear answer, and management defaults to it's still early. I'm hoping we get some metric later on once they're comfortable to share. What I'd be curious to know is, first, just the plain conversion rate, how many people are actually signing deals from bootcamps, but also later on if they figure out the timeline that works best or even the number of bootcamps an organization needs to go through in order to be convinced to make a deal. And truthfully, CARP discloses they are great at running the boot camps to teach and educate customers on how to use artificial intelligence effectively and correctly, but still are figuring out how they can get the sales side done. Naturally, they are still winning deals because the value is so apparent and the product works, but his admission notes there is progress still to be made. Then the other big question brought up by Mariana from Bank of America is how will they meet the expanding demand for AIP? And from my ears, at least, nothing too specific came out of this, like hiring or strategies or just learning from now, but they literally do let us know the results speak for themselves, giving customers a hands-on experience beyond AI being applied to chat, as well as the level of experience being a big factor on how fast it can scale up deals. CARP notes how the customers within Ontology and Foundry or a combination of Palantir's products are the ones who are seeing the fastest progress with AIP. So for me, it sounds like more of a matter of time to keep educating folks on the product, but who knows, we may get something else down the line to help this and accelerate it. So for me personally, the results spoke the loudest here. Still glad for the extra color and enthusiasm and context from management during the earnings call, and I'm happiest about the continued growth of customer count and the surprising overperformance for revenue and their Q2 guidance continuing the trend of revenue growth picking back up. But let me know your thoughts below, and I'll see you in the next video.